Hello everyone and welcome back to another video. In today's video, we are going to be talking about the updates to Michael Burry's short thesis because he has been putting out some new tweets and updating the public with why he is shorting the artificial intelligence sector. I think it's interesting to pay attention to what Michael Burry is doing, and I will be sharing my opinions on his new updated thesis. Then I want to update you on why I think Metastock is looking interesting today, and then we will be wrapping up the video by discussing CRWV and some massive red flags that I found on this business that I do not see a lot of people discussing currently. But before we get into the video, I have two major announcements that I want to let you know about. The first one is that my Black Friday sale on my 30-hour new investment course is officially live, and you can save 40% on my investment course by heading over to my website, www.danielpronk.com, and entering in the code Black Friday at checkout. Or you can click the link at the top of the description, and that will automatically apply the code at checkout. This is an investment course that I have been working on for over 18 months now. I truly put everything I know about investing into this course, so if you're looking to level up your investing and level up your fundamental analysis, then there is no better time to go and get my course than right now, because this is the largest sale that I will be doing for the entire year. Now, the second major update is that the Stock Unlock app is finally done and live on Android. We are working to get it launched on Apple and iOS as soon as possible, but we're just waiting for Apple to approve our app, and we don't really know how long that could take. But we are approved on the Play Store, so you can now go and search Stock Unlock on the Play Store and download the Stock Unlock app to your Android device. I will also be leaving a link in the description if you just want a quick way to go and download the Stock Unlock app. We have been working on this app for almost a year now, and I strongly believe that it is the best app for stock analysis and portfolio tracking, and we are going to be upgrading it rapidly. So what you're seeing right now is like the V1, the very first initial version, but we plan on continuing to upgrade it, and we are actively upgrading it in the background. And I'm just very happy that it is finally launched and that you can go download it and play around with it. But with those two updates out of the way, let's now hop in to the tweets that Michael Burry has sent out, updating us on his short thesis on artificial intelligence. So here's the first one, and in the screenshot he says, "Understating depreciation by extending useful life of assets artificially boosts earnings, one of the more common frauds of the modern era. Massively ramping capex through purchase of NVIDIA chips and servers on a 2 to 3 year product cycle should not result in the extension of useful lives of compute equipment. Yet this is exactly what all the hyperscalers have done. By my estimates, they will understate depreciation by 176 billion between 2026 and 2028. By 2028, Oracle will overstate earnings by 27%, Meta by 21%, etc. But it gets worse. More details coming November 25th. Stay tuned." So in this tweet, Michael Burry is saying that all of the major hyperscalers are overstating their earnings by a significant amount because they're extending the useful life of the NVIDIA GPUs that they are purchasing, which is a large portion of all of the capex that these hyperscalers are doing. And if they were properly reporting their depreciation, then their earnings would be significantly lower. So he is continuing to say that this is a massive fraud and that these companies are significantly overvalued, and that is why he is shorting the artificial intelligence space. And let me give you a quick example to help explain his thesis here. So let's say that you buy a piece of heavy machinery for your business for $1 million, and that machinery is able to work for the next 3 years before you need to buy new equipment and replace it. In this scenario, on your income statement, you do not have to take the full $1 million hit right away. Instead, you would write this off as an expense over the life of the asset, which again is 3 years, which would mean that you would have $333,000 per year reported as depreciation against your earnings. Businesses do this so that they do not take on large one-time expenses against their earnings. And they also do this to smooth out their earnings and not have them be so lumpy. So in our machinery example, by the time the machine needs to be replaced on year 3, it's already been factored in and written off against the company's earnings and expenses, but again, it is written off consistently over the 3-year period and not all at once. Now, what Michael Burry is accusing these businesses of doing is saying that their pieces of machinery actually have useful lives of 6 years instead of 3, which spreads the depreciation expense over more years and inflates their earnings. This would mean that the depreciation expense on that piece of heavy machinery would drop down to $167,000 per year and allow you to report the remaining $167,000 as earnings. However, this becomes a problem if the true working life of the asset is 3 years and not 6 years, because in reality, you will have to replace that equipment every 3 years. So in this scenario, you would have to spend real cash to replace the asset, but on your income statement, you would still be writing it off for an additional 3 years and boosting your net income by doing so. Basically, Michael Burry is saying that the hyperscalers' useful life of their assets versus the depreciation timeline are at a mismatch, which is causing the hyperscalers to overstate their earnings significantly. So, at the heart of Michael Burry's short thesis is the question: what is the actual useful life of all of the GPUs that the hyperscalers are buying? Well, the consensus in the tech community suggests that Michael Burry's 2 to 3 year estimate for peak performance use is likely correct. However, the hyperscalers argue that while chips may become obsolete for training new models, they are still useful and valuable for performing other tasks. This is why the hyperscalers have extended the useful life of their assets to 6 years, because they're still able to use these GPUs and produce value from them. In Microsoft's most recent earnings report, their CFO also addressed the depreciation timeline. And here they said, Number one, we're pivoting toward increasingly, we talked about this, short-lived assets, both GPUs and CPUs. Again, we talk about all these workloads are burning both in terms of app building. Now, when that happens, short-lived assets generally are done to match sort of the duration of the contract or the duration of your expectations of those contracts. I sometimes think when people think about risk, they're not realizing that most of the lifetimes of these and the lifetimes of the contracts are very similar. When you think about having revenue and the bookings incoming on the balance sheet and the depreciation of short-lived assets, they're actually quite matched. So what the CFO of Microsoft is saying here is that Microsoft matches the contracts from customers to the useful life of their assets that they need to buy to actually deliver on those contracts. This results in Microsoft factoring in the pricing of GPUs to the contract and making sure they're compensated fairly and offset the depreciation expense. I also found a quote from the vice president of Google Cloud where he said that Google has 7 to 8 year old TPUs that are still running at 100% utilization. And this helps support the extension of the useful life assets that the hyperscalers are doing. So what is my conclusion on all of this? Well, I think that it's pretty clear that the hyperscalers are definitely spending a lot more on capital expenditures and buying a lot more GPUs from NVIDIA, and this is going to increase their depreciation expenses significantly. In fact, Meta's CFO in their Q3 earnings report even said that their depreciation expenses are going to start accelerating in the next year, and that investors should expect them to be significantly higher. However, I do not necessarily believe that the hyperscalers are being malicious or trying to mislead the public by extending the useful life of their GPUs and the assets that they're buying, because it seems pretty clear that they can take their GPUs that they purchased and use them elsewhere in the business to continue delivering value to their overall business and to their customers. So these assets that they're buying from NVIDIA, these GPUs that they're buying, they're not stopping using them right after 3 years, and they're actually finding other areas in the business to continue using them, potentially even past 5 to 6 years. And again, the VP of Google Cloud is even saying that their own TPUs are lasting 7 to 8 years and still running at 100% utilization. So I do think that there is evidence. So I do think that there is real and tangible evidence that these businesses are able to continue getting value from these GPUs beyond 3 years. And that is why they extended the useful life of the depreciation. Now, what I also think is that you can remove a lot of the noise of depreciation by simply going and taking a look at these businesses' cash flows, because depreciation is impacting the net income of the business. But what the cash flow statement does is it strips away all of the non-cash expenses, which depreciation is. Depreciation is a non-cash expense, but it is still a real cash expense when you have to replace the asset. So what we can do is simply go and take a look at Google's operating cash flows. And here we can see that Google's business produced $151.4 billion in operating cash flows over the past year. And we can also see that Google's operating cash flows are continuing to grow significantly. So the profitability of Google's operations is continuing to grow. However, when we take a look at free cash flows, we can see that Google has now produced $73.6 billion in the trailing 12 months, and Google's free cash flows are not really growing. In the trailing 12 months ended the first quarter of 2022, they produced roughly $69 billion of free cash flow. So Google's free cash flows have only grown by roughly $4 billion over the past 3 years, because they're continuing to invest more and more money into capital expenditures and trying to expand the business. Now, in my opinion, as long as the revenues and the operating cash flows are continuing to grow and at rapid rates, then it suggests that the capital expenditures and the investments that they're putting back into the business are actually paying off and growing the business and its overall profitability. And what we're seeing is as the operating profits, which is the operating cash flows, continue to grow, then they are taking that and plowing it into more and more capital expenditures. And that is kind of the flywheel that they have going on right now. My other, more slightly bearish thought towards all of the hyperscalers, though, is that a portion of these large increased capital expenditures that they are doing could be sustaining capex over the long term. And what that ultimately means is that the free cash flow margins of Google may be compressed over the long term as they have to continue recycling their GPUs, upgrading the GPUs, and maintaining all of these massive data centers that they are building out. And what I think this could result in is these businesses being more capital intensive in the future and not nearly as lean as they once were. For example, back in 2017, Google had a free cash flow margin of 29%. But due to all of the capital expenditures that the business is doing now, it's sitting at 19% in the trailing 12 months. It's also clear that Google is spending a lot of money on capital expenditures that are growing the business, but I do think that the sustaining capex of these businesses is ultimately growing. So maybe long term, when the business is mature and they're not investing so much into capex to grow their data centers and whatnot, maybe the matured free cash flow margin is somewhere around 22 to 25% on a sustaining go forward basis. I don't necessarily think that this is a huge bearish point though, because I would rather have a company earn a net more money, even if the profit margins are a little bit lower. For example, I would much rather earn $1 million in profits on $10 million of revenue than $500,000 of profits on $1 million in revenue. So as long as these companies' capital expenditures are continuing to grow the top line and ultimately continuing to grow the net free cash flow that they can produce over the long term, then I do think that it is worth it and it will continue to grow shareholder value. I just think that the profit margins of all of these businesses could be compressed over the long term due to higher sustaining capex than they had to do in the past. Because I think that it is pretty clear that these businesses are becoming more capital intensive. Now, the last point that I want to address is that Michael Burry is shorting Palantir and Nvidia, despite him addressing Meta, Google, and Amazon in his tweets. And the reason why I think Burry is shorting Palantir and Nvidia and not a company like Meta, which he actually named in his tweet, is simply because Palantir is trading for insane prices, okay? It is still trading for 111 times sales and 241 times free cash flows. So if it ever does come out that the hyperscalers are overstating their earnings, then it could cause a massive deflation to the overall hype in the artificial intelligence sector. And the two companies that are leading the artificial intelligence wave right now and all of the hype are Palantir and Nvidia. These companies are trading for very high price multiples. I think Palantir is way more overvalued than Nvidia, and there's actually an argument that Nvidia is not massively overvalued if they can continue their extremely high growth rates. But it's pretty clear that he is just shorting the most hyped up names within the artificial intelligence space. So if it comes out that the hyperscalers are overinflating their earnings, then the hype within the AI space could decline. And when that happens, I think Palantir is probably one of the stocks that has the most downside potential because it is the most overvalued stock within this entire space. So to put that simply, I think Michael Burry thinks that Palantir has the most downside potential, and that is why he chose this one to short if the overall AI hype starts to fade. We're also going to have to see what he posts on November 25th because he did say that more is coming soon. And I will be updating you on my channel when his new tweets come out or if any new information actually surfaces on this ominous November 25th date. So stay tuned, I guess. But with that being said, let's now move on to the next segment of the video, which I want to talk about, which is actually Meta, funny enough, because Meta stock has been selling off quite a bit after they reported earnings, and the stock is now in a 23% correction from its all-time highs. And this is very surprising to me because I thought that Meta had one of the best earnings reports out of all of the hyperscalers. They had the fastest revenue growth rate at 26% year over year, and the business's fundamentals seem like they are starting to accelerate. Here we're taking a look at Meta's revenue, and we can see that in the trailing 12 months, they've now produced $189.5 billion. And if we turn on the percent change, we can see that Meta's revenue growth rates have been accelerating over the past 2 quarters. And I think that they're setting up to have a massive, massive fourth quarter. If we also take a look at Meta's operating cash flows, we can see that they are continuing to hit a record high of $107.6 billion in the trailing 12 months, and it seems like this business's operating profits are continuing to scale and grow rapidly. However, just like with Google, Meta's free cash flows are actually declining over the past 4 quarters because they are spending a lot more money on capital expenditures, which Michael Burry thinks is a very bearish point. But personally, I think that as long as Meta's revenues are growing and actually accelerating, and its operating profits are continuing to grow, then the capex is arguably paying off and could continue to grow shareholder value. I also found these charts online, which show the overall US ad spending annually, the market share of Amazon, Meta, and Google, and the year-over-year change to the advertising revenue of these three businesses. And what we can see in this first chart is that the overall dollars spent on advertising within the United States is clearly growing, which is obviously a tailwind for all of the advertising companies. Then we can see the share of the US advertising market, and we can see that Amazon, Meta, and Google make up over 50% of the advertising market in the US, which I think is pretty insane. But what we can also see is that Meta has been taking a significant amount of market share. Google still has the most market share by far, and Google's market share is actually still growing overall. But Meta's market share is growing at a much faster pace than both Google and Amazon. Amazon is still taking market share and growing at a faster rate than Google as well, but Meta, I think, is the outlier here. And I think that we can also see that Meta is the outlier by taking a look at the year-on-year change in advertising revenue, especially in the most recent quarter. Meta grew their advertising revenue by 26% last quarter. Amazon had a very strong quarter as well, somewhere around 23 to 24%, and Alphabet had 16% year-over-year growth to their advertising revenue. And by the way, I think that all of these growth rates are strong, and it is great to see that all three businesses are seeing an acceleration to their growth rates, but Meta is the clear outlier right here, and it is definitely coming in number one. And what's also interesting is Meta had the highest advertising growth rate despite it having a larger base to grow from than Amazon. So I think that Q3 was a very impressive quarter for Meta, and it's clear that more advertising dollars are being attracted to Meta's platform specifically. And I think that this is most likely because advertisers are seeing a higher return on their advertising spend on Meta's platforms rather than on Amazon and Google. And as they are getting a higher return on invested capital with Meta, they naturally want to put more of their capital towards that source. So I think that's a clear indicator that Meta's services and their platform has the highest return on invested capital with customers as well. So now let's go take a look at Meta's price today. And my favorite metric for all of the hyperscalers right now is the price to operating cash flows, because I think that the operating cash flows is the best metric for all of these businesses. And currently, Meta is trading for a price to operating cash flow of roughly 14.4, and its average since 2018 has been roughly 15.6. So Meta is trading below its historical average price to operating cash flow, and it's also trading for a pretty significant discount to the other main hyperscalers, which are Google, Amazon, and Microsoft. So let me just put these in the chart quick. And here we can see that Meta's price to operating cash flow is around 14.7, Google is 23, Amazon is 20.4, and Microsoft is sitting at 25.7. So Microsoft is still the most expensive stock, Google is second, Amazon is third, and then Meta is the clear outlier here, selling for a pretty steep discount of 14.7. Now, to be clear, I do think that Meta's business deserves to sell for a discount to the other main hyperscalers because Amazon, Google, and Microsoft have much more diverse cash flows. Meta's business is entirely reliant on advertising revenue and advertising spend. So if the overall advertising market slows down, then Meta's business is the most impacted. Google has Google Cloud, YouTube, and a bunch of other businesses. Amazon has AWS, their e-commerce business, and Microsoft has Azure and all of their different Microsoft products. So again, those businesses are much, much more diverse. And because they have more diverse and consistent cash flows, I do think that they deserve to sell for a premium. But I don't think that Meta deserves to sell for the steep discount that it is at today. And it is even trading below its long-term historical average price multiples. So what I did is ran a quick discounted cash flow calculation on Meta. And over the next 5 years, I am saying that Meta will continue to grow its operating cash flows by about 12% annually, which is actually a large deceleration from the current growth rates that the company is seeing, which are well above 20%. I am also saying that Meta will trade for a 14.9 price to operating cash flow, which is its average over the past 5 years. And if Meta can grow by 12% annually and maintain a roughly 15 price to operating cash flow multiple, then the stock could compound by roughly 15% annually from its current price, and its fair value would be $773 per share, which is 26% above where the stock is currently trading. So I do think that Meta stock is looking quite interesting today, and I think that if the business can even grow by modest growth rates of 12% annually from here, then it could deliver market-beating returns. And again, I am surprised that the stock is selling off after the most recent earnings report because I thought that it was a very bullish report with the most top-line growth out of all of the hyperscalers. It really just doesn't make that much sense to me. Like, I get that Meta is clearly saying that they're going to be spending a lot more money on CapEx over the next year. The depreciation expenses are going to grow next year. But I don't think that Mark Zuckerberg would be plowing so much money into CapEx if he didn't think that the business would be getting high returns on the CapEx. And I also think that the sheer amount of revenue and operating cash flow growth that Meta is seeing right now is suggesting that they are getting great returns on the CapEx that they are doing. So maybe the share price weakness is due to analysts and hedge funds thinking short term and knowing that Meta's profits are probably going to be subdued over the next year. But for long term investors who believe that this CapEx will grow the profits of the business again over the long term, then it could be looking like a compelling price today. And that's why I am interested in Meta stock and why I think that it is looking compelling at its current price. All right, let's now move on to the last segment of the video, which is going to be our discussion on CoreWeave and identifying all of the red flags that I have been seeing in this business. But first, let's talk about CoreWeave's share price movement. So here we can see that the stock IPO'd in March of 2025, and after it IPO'd, it saw a rapid increase of 360%. And since its peak here in June of 2025, it is now down roughly 53.5%. And over the past month, it has seen a sell-off of roughly 40%, and it has also sold off even more after its Q3 earnings results. Now, for those of you who may not know, CoreWeave is a data center company. So they have data centers, and then they rent out their GPUs and their data center space to companies like Microsoft and Meta. That's pretty much the entire business model, and I have been openly bearish on this business model on my channel over the past few months. And I've actually made a video on why I think IRIN and NBIS are also significantly overvalued. So I went through CoreWeave's most recent earnings report to see why the stock is down and also to see why it is continuing to be extremely hyped up on social media. And right here, we can see that in the third quarter, revenue came in at 1.4 billion, which is up 134% year over year. They also have a revenue backlog of 55.6 billion now, which is up 271% year over year. Adjusted EBITDA came in at 838 million, which was a 61% margin, and adjusted operating income came in at 217 million, which is a 16% margin. So what I'm seeing on this first slide is that CoreWeave's revenue grew significantly. It more than doubled its revenue for the third quarter year over year. Its revenue backlog is also up almost 300%, but then the red flags start because they're promoting and highlighting their adjusted EBITDA metric and their adjusted EBITDA margin. And whenever a company reports their adjusted EBITDA or an adjusted metric, I always go and take a look at what are they adjusting out to get this metric, or what are they adding in to get this $838 million. And my ultimate question is, do the adjustments make sense? Do they more accurately reflect the profits and the cash flow of the business? Or are they adding back numbers that are true cash expenses that are moving the metric further and further away from the profit potential of the company? And that's what we're going to take a look at here in a minute. But first, let's take a look at the revenue growth. Once again, revenue was extremely strong, came in at that $1.37 billion, up from 584 million the previous year. The next slide shows their adjusted EBITDA. We can see once again they're promoting their 61% adjusted EBITDA margin, and they say adjusted EBITDA was more than 2x the third quarter of 2024, which was 379 million. So once again, really telling investors that adjusted EBITDA is growing and their margins are high. Now let's move on and take a look at their income statement. And right here, we can see that revenue once again more than doubled. But what I'm noticing is operating expenses also more than doubled to $1.312 billion, which resulted in operating income coming in at 51.9 million, which is actually lower than their operating income in the third quarter of 2024. Operating income was pretty much cut in half. And this is because, once again, the operating expenses of the business are growing at a faster rate than the revenue, which is not great to see. Moving on, we can see that interest expense nearly 3x'd year over year to $310 million on the quarter versus $104 million last year. This is the interest payments on debt. And again, the interest payments tripled year over year. These interest payments are also roughly 22% of the company's revenue. So 22% of revenue goes to paying off the interest on their debt alone, which is in freaking sane. However, further down the income statement, we can see that adjusted EBITDA is sitting at 838 million, and it did more than double year over year. And that is what they're trying to show investors. So now let's go and take a look at the adjustments that they make to their EBITDA to get this adjusted EBITDA number. And right away, we can see that depreciation and amortization was $630 million for the third quarter alone. And this is added back to get their EBITDA. Then we can see they also add back their interest expense of 310 million because EBITDA is earnings before interest, taxes, depreciation, and amortization. So these two metrics are added back to the adjusted EBITDA, and together they equal $940 million. And these two expenses alone are 70% of CoreWeave's revenue that they are just completely removing from their adjusted EBITDA. And again, they are highlighting this adjusted EBITDA number to their investors. It's on page 1 of their Q3 investor presentation. And they are also highlighting their 61% adjusted EBITDA margin as if this is their profit margin. But this is far, far away from profits. It's not even a close reflection of how profitable the business actually is. And for a business like CoreWeave, I do think that their depreciation expenses are recurring and a real cash expense that investors should think about. And basically, when you factor in these real cash expenses, the business is not profitable at all. And this has always been my concern with the companies like CoreWeave and Iron, is that when you take a look and factor in the actual true cash expenses, they're not really profitable at all. Their profit margins are extremely, extremely thin. But I'm seeing investors value these companies off of their adjusted EBITDA and also applying price to sales multiples on these companies when I think that their profit margins are going to be well below 10% when they're matured businesses. And that is extremely risky. So now let's go and take a look at the cash flow statement here. And we can see that for the first 9 months of the year, CoreWeave has produced about $1.5 billion of operating cash flows, which is down roughly $1 billion year over year. So CoreWeave's operations are actually producing billions in cash flows, which is good to see. But take a look at this. Their capital expenditures so far for the year have been $6.2 billion and $5.2 billion in the previous year. Now, this on its own is not a massive red flag because it's been clear that these data center companies have a lot more demand than they can execute on or that they can deliver. So what they are all doing right now is building out as much data center capacity as they possibly can. And they are plowing every dollar that they can get their hand on into trying to build more capacity to sell to companies like Microsoft. So again, this CapEx on its own, I do understand because there's this huge opportunity, or at least in CoreWeave's eyes, there's this huge opportunity that they cannot execute on right now. And by plowing more money into CapEx, they can grow their capacity and execute on all of that demand. But my question is, how are they funding this massive CapEx build out then? And in CoreWeave's case, it's through taking on a lot of freaking debt. Year to date, they have taken on a net of somewhere around $5 billion of debt. And last year, they took on a net of $3 billion of debt just in the first 9 months of the year. So CoreWeave is clearly funding this data center build out by taking on billions and billions of dollars of debt. So let's go and take a look at their balance sheet now. And we can see that CoreWeave has $4.7 billion of current liquid assets, which is good to see on its own. They also have property, plant, and equipment of $20 billion now. However, if we take a look at their liabilities, they have current liabilities of $9.7 billion and total liabilities of $29 billion now. And what concerns me is the current assets or the liquid assets versus the debts that are due within the next year, which are the current liabilities, because they have $5 billion more of current liabilities than liquid assets. Now, again, this on its own would not be a massive red flag. I actually have companies within my own portfolio that have a lot more current liabilities than current assets. But the thing about these businesses in my portfolio is that they are extremely profitable and producing a lot of free cash flow. And the free cash flow that they produce over the next year, they can use to pay off the current liabilities. So there's not that much risk. But the risk with a company like CoreWeave is that, as we saw, they are not producing any free cash flow. In fact, they're losing billions of dollars of free cash flow right now while they're building out more data centers. Pile that on with the fact that they have a net of $5 billion of a deficit on their balance sheet over the next year, suggests to me that they're going to have to raise a lot more debt to handle their current debt or they're going to have to dilute shareholders significantly to raise money to pay off this debt. So when you have a company that is losing a significant amount of money, it's free cash flow negative, deep in the red, and it also has significantly more current liabilities than current assets. It means that the company is in a very financially stressed position. Its finances are not good, and it's going to have to find more money quick. And that's what I'm seeing with CoreWeave. Now, also, they do not show the balance sheet or the cash flow statement on their quarterly investor presentation that they put out. In their Q3 update to investors, they intentionally left out the cash flow statement and the balance sheet. That was a decision on the management. They only showed their income statement, which also showed their adjusted EBITDA. And then later on at the bottom of that presentation, they showed their calculations to get adjusted EBITDA. Now, my question is, why did the management deliberately not put in the balance sheet and the cash flow statement? Something for you to think about. In my opinion, it's because when you take a look at the balance sheet and the cash flow statement, it is very, very clear that this business is over leveraged and they're going to have to raise more money within the next like 6 months, or they're literally going to run out of cash. It's in a very financially bad position. It's a major, 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 major red flag for me. Now, on top of all of this, we can see that insiders have been selling a ridiculous amount of shares. Let me show you this on Stock Unlock. So take a look at all of this selling, okay? All of this selling. There is so much selling going on. And these are sells in the tens of millions of dollars. This is $100 million sell right there. There's tens of millions of dollars of sales from the co-founder. You know, you think that these people would be bullish on their own company, but they are all selling so many freaking shares. And all of the sells that you just saw on your screen are just over the past, are just since October 22nd of this year. So over the past 2 weeks, there has been this much insider selling going on in the hundreds of millions of dollars, even in the billions of dollars. So it seems like the insiders are trying to offload as many shares as they possibly can. And you know what? I can't even blame them because this company has a $43 billion valuation, is trading for 10 times sales, which is a higher multiple than Meta right now, even though this company is pretty much losing money. They are not producing any profits, and I would be shocked if long term they actually have a profit margin of 5 to 10%. So valuing this company at 10 times sales is ridiculous. I think that it is significantly overvalued. And all around, this company screams red flags to me. Now, I went and listened to the CEO interview. I wanted to play it, but I think that this video is getting a little bit too long to also play the interview. But CoreWeave uses a company called Cores, I believe, Core Scientific. And the reason why CoreWeave missed its revenue guidance in the third quarter is because this company, Core Scientific, is one of their data center providers. They actually help build their data centers and operate the data centers. And Core Scientific is delaying some of CoreWeave's data centers, and that is causing them to not be able to execute on the work as quickly. Now, I took a look into Core Scientific, and this company screams red flags to me. It is surprising that CoreWeave is relying on a company like Core Scientific because Core Scientific is also losing a lot of money. They are not profitable, and they are taking on debt, and they're burning through that debt now, and it's not a good look. And then when I started to take a deeper look into this whole story, I found out that in 2024, CoreWeave put in a bid to acquire Core Scientific for $9 billion, but Core Scientific shareholders declined the acquisition. So CoreWeave put in a $9 billion bid for Core Scientific right here, when Core Scientific is losing money and the revenues are also declining. This company is producing roughly $300 million in annual revenue, so CoreWeave put in a 30 times sales bid for Core Scientific. That is like throwing cash into an incinerator. And the fact that CoreWeave even tried to acquire this company at that multiple suggests that the management does not know how to deploy capital, and they just are caught up in the hype themselves. Because Core Scientific is definitely not worth 9 billion, not even freaking close. That is another major red flag, that the management is so willy-nilly with the business's capital. So the deeper I look into CoreWeave, the more and more red flags that I see. But this is one of the popular stocks on social media right now. Its stock ran almost 400% after its IPO. It's still trading for an insanely high valuation, and it's getting a lot of attention in the market today. It doesn't necessarily surprise me because investors typically like to focus on revenue growth in the short term. So as long as revenue is growing 100% year over year, then I think it will be an exciting stock, especially for retail investors. But the actual fundamentals of this business are terrible. And I would be shocked if this stock over the next 5 years is still trading for $85 per share. I'm not a short seller. Every time I talk about a stock negatively, I get comments like, well, then why don't you short it, Daniel? I don't have to. I'm just telling you that the fundamentals of this business are terrible and it's massively overvalued. And this is the type of stuff that is popular in the market right now. And there's two quotes that I think about whenever I take a look at a stock like CoreWeave. And the first one is from The Intelligent Investor, where it says, obvious prospects for physical growth do not translate into obvious profits for investors. What that ultimately means is that just because a business is obviously going to grow in the future does not mean that the investors are going to make money. There are so many examples of this throughout history, especially in the airline and automotive industries. But I think that right now, it is obvious that the data center space is going to grow significantly over the next 5 years as all of these hyperscalers need more and more compute. But I don't necessarily think that means that these data center companies like CoreWeave and Iron are going to make their investors a lot of money. Because one, the prices are already reflecting so much future growth today. And two, I think that the profit potential of these businesses is extremely questionable. And I also think that the managements of these companies are not deploying shareholder dollars effectively. So I don't think that just because this company is growing its revenue, that it is actually going to produce profits for shareholders. And then the second quote comes from Warren Buffett. I don't remember the exact quote, but it's something along the lines of, not all growth is good. And I agree. And as we saw with CoreWeave, its revenue is growing, but as the revenue grows, it's actually earning less money. And this is because its expenses are growing at a faster rate than the revenue. And whenever I see this, like, yes, the revenue is growing, but as I have said on my channel many times, revenue growth is not the holy grail of investing. You need to have profitability growth and actual cash profit growth to create shareholder value. And with a company like CoreWeave, I am just not seeing that. I am seeing that as the revenue grows, it's actually losing more and more money. So revenue growth in this scenario, I don't think is going to lead to shareholder value growth over the long term. And I think that's an important point to make. So with that being said, I am done ripping on CoreWeave. It's just kind of fun to take a look at these things and identify how many freaking red flags I can find, because there's a lot. But before I wrap up the video, I just want to remind you that my 30-hour-long investment course is having the Black Friday sale right now. You can click the link at the top of the description to save 40% on my investment course, or you can head to my website and use the code Black Friday at checkout. And again, you can save 40% by doing so. Also, the Stock Unlock app is officially on Android. I would love if you guys could go and download it and give me some feedback. We've been working on this app for over a year, as I said at the beginning of the video, and I think that you are going to love it. It's literally the best portfolio tracking app I have ever seen. But with all that being said, that is going to wrap up the video, everyone. So thank you so much for tuning in. As always, I truly do appreciate it, and I really hope to see you again in my next video.